Alright, so in this video, I'll be talking about a very common experience that everyone will face in the stock market at one time or another, which is you buy a stock which you think is a good stock. You got a tip from the broker, you got a recommendation, and you bought a stock like Nike, for example, at $67.50 with all your hopes and dreams that it's going to go to the moon, you're going to get rich. But the moment you buy it, what happens? The price drops 5%, 10%, 15%, or even 25% down. And you're panicky, you don't know what to do. Do you hold on for dear life? Do you get out before it gets worse? Or do you buy more and have the confidence it's going to recover in the future? So this is one of the most common questions I get in my seminars. And the reason is because most beginners are confused because of the different advice given by different courses, different books, different investors out there. For example, if you read books like How to Trade in Stocks, written about Jesse Livermore, a legendary trader, or if you read a book like How to Make Money in Stocks by William O'Neill, who created Investors.com. These books and courses will tell you that the moment you buy a stock and it drops by 10 or 20%, you got to cut your loss immediately. In fact, you got to place a stop loss and get out. Never ever buy when it's going down. Never average your losers. But then again, if you read about Benjamin Graham or Warren Buffett, and these are books like The Intelligent Investor or this book known as Beating the Street, they give you a very different advice. They tell you that if you buy a stock, if it drops 20-30%, you're getting a better discount. You should buy more shares at a discount. Average down your costs and have faith in the long run, because in the long run, it will always go up. So who the heck is right? Who do you listen to? Well, there are times when the first piece of advice will be good, and there are times the second piece of advice will be good. Let's take a look at a few examples. Let's look at General Electric. Imagine if you had listened to the advice of buying more at a lower price, and you bought GE at, for example, $33, somewhere over here, right? And you bought at $33, you think, hey, it's a great company, I'm an investor, and it goes down, and you say, you know what? I get a discount, I'm going to buy more. And it goes up, all right, and it goes down, I'm going to buy more, buy more, buy more, buy more. It's going to come back one day, have hope, believe in the company. One is going to go up, right? $7 from $33 to $7. That's like 80 or 90% decline. So clearly, in this case, buying more was not the right thing to do. It would have destroyed your portfolio, right? Here's another example. This stock known as Transocean. Okay, same thing. It was selling at $180 something about 10 years ago. And again, imagine if you listen to the advice of buying more at a lower price. So at $180 dropped to $60. You say, wow, I'm getting a great discount, right? So buy more, average my cost down, goes up, all right, it's going up, then goes down again, buy some more, goes up. And you're happy, goes down again, buy some more, and 10 years later, it's at $8.10. So another disaster if you had bought more on the way down. But on the other hand, look at a stock like Alphabet, which owns Google and YouTube. So the stock was selling at about $250 about 10 years ago. And in this case, that would have worked, right? You bought at $250 and it dropped to, for example, $150. You say, hey, I'm getting it at half price. I'm going to buy more and average down, because in the long run it's going to go up. And sure enough, boom, it went all the way, and now it's about $1,100 to $1,200. So in this case, it would have been the right decision to hold and buy more, but not in the first two cases. So how would you know when to follow the first advice to cut losses fast, or to follow the second advice, which is to hold on for dear life and buy more at a lower price? What's the right thing to do? So once again, if you've bought a stock and the price has dropped 10 or 20%, do you get out, do you hold, or do you buy more? What's the correct answer? And the answer really depends on when you bought that stock, what was your purpose of buying it in the first place? Was it meant to be an investment or a short-term trade? For example, is it like a long-term relationship you're getting into, or is it a one-night stand? Now, if it was an investment you're getting into, then you have to thoroughly understand the business behind the stock by doing fundamental analysis, by studying the financial statements of the company to know it's fundamentally a great business. So in my value momentum investing course, I teach people that a stock has to pass 7 steps for it to be a great business, for us to invest in. So what are these 7 steps? So I'm going to run through them really quickly, right? So number 1, for it to be a great business, it has got to show consistent increase in sales, earnings, and cash flow from operations for the last 5 to 10 years. That's a must. Number 2, the company has got to have a positive future growth rate based on a growth catalyst. The company has to have a sustainable competitive advantage, or we call it an economic moat that protects it from future competition. It's got a monopolistic edge over its competition. The company has to have very high and consistent ROE, or return on equity. And we only invest in businesses with very low or conservative debt. Now, once it's a great business, we only buy when the price is right, when the stock price is selling below the intrinsic value of the company. In other words, we only buy when it's undervalued. We call that value investing. But we don't just buy it when it's cheap. We buy it when there's upward momentum. So the last step is we look for a great point of entry to enter when the price is reversing from a downtrend to an uptrend, or it's making a dip on an uptrend. You see, when you know that it's a fundamentally good business, you are confident that in the long run, the company will increase in value in the long run. So you know that 5 to 10 years from now, the company is going to be worth a lot more. It's going to have more sales, more profits, and so on and so forth. But we know that as the company goes up in the long run, in the short term, we have market volatility because of market sentiment, because of news. So for example, during the trade war, you may find that the price may go down because the whole market's bearish. And then you've got good news, right? GDP is great and the market goes up, and it goes down, it goes up, and so on and so forth, right? So you can see that although the value of the company goes up over time, but in the short term, the stock price could drop below the true value. This is when it is undervalued. And there are times when the market is really excited, the price can be way overvalued, above the intrinsic value. So for an investment, when the price drops, for example, 20 or 50% below the valuation, you are confident to buy as much as you can, because you know in the long run it will always go up, because the valuation will always be in the future, provided it passes these 7 steps of being a fundamentally good business. So now that you understand this, let's go back to those 3 examples. Let's revisit. So the first is Alphabet, Google. Back in 2009, during the financial crisis, people panicked, right? Market sentiment was bad, and the stock dropped from $400 down 50% to $200, and all the way down to $150. So that was like a 65% decline. So at that time, would you have got out, or would you have bought more? And the answer is you have bought more, you have held on. Why? Because Alphabet is a fundamentally good business, because it passes all the 7 criteria I talked about. So let's take a look, for example, at the first criteria. Does this company have consistent increase in sales, net income, and cash flow from operations? Yes, every single year. Now, I don't have the data going back beyond 2009 because they've removed it, but at the time, I could see the data way before 2009. And it was the same thing then, it's the same thing now. So you can see that for Alphabet, the net income increases consistently every single year. Now, of course, 1 year dip doesn't really matter as long as it bounces back the next year. Okay? And revenue, as you can see, increases consistently every single year as well. So at that time, back in 2009, when the stock crashed 50%, I did a valuation. So for investments, you got to do an intrinsic valuation. So I've got this calculator which my students use in the value momentum investing course, where you're going to learn how to put in the data. It takes less than 5 minutes, and it will tell you the true value of the stock based on the company's cash flow from operations. Okay, you can see it was 9 billion back in 2009 based on the total debt of the company, and Alphabet had 0 debt, no debt, and these are the companies we want to invest in. The company had 24 billion in cash, short-term investments. It was growing at 25% a year. And based on 327 million shares, you can see the intrinsic value was at the time $863. So in other words, the stock was selling at $200 or $150, but the value is $800. So why? Because in the short term, the stock market is irrational. The market is emotional. So something worth 800 could be selling at 200 bucks. That's what we call the Great Wall Street Sale, and it happens during crisis and panic. So as a great investor, you have to learn to buy when others are fearful because you know what it's truly worth. And again, if you had done that, what I did, and bought at the time when people are fearful, you have made a lot of money because it was an investment. But let's look at GE. So again, let's imagine that you started buying GE at about $33 or $31 back in 2007, just 2 years ago. And after you bought it, it dropped, for example, to $25, right? It dropped about 15%. Would you have bought more there? Well, the answer would be, is it an investment? Is it a stock that you can invest in? Remember, not all stocks are investable. Some stocks are only good for a one-night stand. They're not good for a long-term relationship, right? So was GE at that time something that you would consider an investment? The answer is no, because GE fails almost all of my 7 steps. In fact, it already fails the first step. Let's take a look. So you can see, let's go to 2017, which is here, right? So let's imagine at the moment you bought the stock and it dropped. What do you do? That's right. What's step 1? Good investment is one where the business increases sales, profit, and cash flow consistently. And you can see that GE fails the first step. Take a look at the net income from 2009 to 2017. Initially, it was going up, but from 2015, what happened? It lost money. It made money, it lost money again. So this fails step 1. It's no longer a consistently growing company. And that's why you would not have invested in this in the first place. And if you were in it because of a tip that you got to get out. You can't buy more, you can't hold, because it's a lousy company based on the fundamentals at that time. Another example is again Transocean. So again, imagine if you bought over here, you thought it's going up, you bought it back in 2013 when it was selling at 60 bucks, right? You bought at $60, it dropped to $40. So again, you're getting, it's dropped, 10, 20% below your purchase price. Would you have bought more over here? Again, is it an investment? If it is, does it pass my 7 steps? Well, it fails all the 7 steps. Let me just show you step 1 again. Fail step 1. So again, take a look. For the last 10 years, the net income of the company has been extremely inconsistent, right? Made money this year and then made less and lost a lot of money, made a bit, made more, lost money, made some, lost money. So when you see a company that has inconsistent earnings and profit and cash flow, fail step 1, you can't invest in this company. So the answer is we don't have bought this stock in the first place as an investment. If you were in the stock, would you buy more? No, you got to get out immediately because it is not a stock you can invest in. So if you've bought a stock because it's an investment and it's passed all the criteria of a fundamentally great business, then you have the confidence that even if the price drops 20, 30, 50%, just buy as much as you want. Buy, bitches, right? Buy more, average down, get a good discount. So does that mean that you never sell an investment? Of course not. Even Warren Buffett has said that when I buy a stock that's a good business, I'm going to hold it forever. But then, forever is not always forever. There are times when you will sell an investment. So when you sell it, when the fundamentals deteriorate. So you sell an investment not based on what happens to the price, because the price is something that's short term. You sell only when the business is no longer a good business, when the reasons you got in are no longer valid. So for example, number 1, you've got to get out of an investment when the sales, net income, and cash flow begin to become inconsistent. right? It drops for more than 2 years or goes negative. You gotta get out, right? You gotta get out once the company has a negative future growth rate. It's no longer growing in the future. It has lost its competitive advantage. For example, like Nokia. Nokia used to be a monopoly in mobile phones. No more. It lost its competitive advantage. When a company increases its debt to an unsustainable level, you gotta get out. And you can also exit a stock if it's still a good business, but the price is overvalued. For example, Boeing's a great business. I've held it for a couple of months, but last month it became too overvalued. It was selling at something like 30 to 40% above valuation. So I got out because I know eventually it's going to come back down. I'm going to buy it back cheap again. Warren Buffett, bought IBM, he bought GE, and he bought Kraft Heinz. And he's really sold IBM and GE because they're no longer good businesses. So there are times when you must know when to get out when a business is no longer good. Now he's still holding on to Kraft Heinz, but I suspect that Kraft Heinz is no longer a good business. It used to be, but it's no longer a good business, and he could be getting out of that in the future. That's just my guess. So in other words, again, for investments, we can buy more when the price goes down. But having said that, you should also do it intelligently. I keep telling people that on a downtrend, cheap can get cheaper, low can get lower. So I tend to buy when I see uptrend momentum. Again, going back to my alphabet example, as it's going down, you can see that I will not enter, I will not accumulate as long as the trend is down. If you've watched my earlier videos, you know that I use moving averages to help to determine the trend. So when the 50 moving average is below the 150, I avoid adding more. I wait for the 50 moving average to cross above the 150 to show an uptrend momentum. I'll start to buy more here. I'll start to add on. And when it crosses down, I will not add more. Over here, I could add more. I'll add more. And the moment it crosses back, I'll add more. I will add more here. And I'll keep adding. And I'll make a lot of money as it goes up. But when it's going down, I will not add more, but neither would I sell. I'll just hold it waiting for a bottom if it's fundamentally a good business. Now, if you enter a stock as a short-term trade, it's a completely different story. In that situation, the moment you buy and the stock drops by even 5% or sometimes 3%, you gotta sell, you gotta get out, right? Why? Because when you enter as a short-term trade, it's not based on fundamentals. In fact, most of the time when I trade a stock, I've got no idea what the company does. I couldn't care less. Right? I enter a short-term trade purely based on technical analysis, which is reading the price action, and enter when I see a clear uptrend, when I'm going long, when a stock has got momentum. So again, short-term trades are not based on fundamentals. So it could be a lousy company, it could have high debt, could be overvalued, no competitive advantage, but who cares? It's going up, I take a short-term trade. So again, it's like if you want a long-term relationship, you're gonna get married, character, fundamentals are important, right? But for one night stand, you don't really care about the person's character. You don't even care what the person does, right? As long as the person's hot and you're attracted, you just get in and wham bam, thank you ma'am, and get out. Same thing for short-term trading. So like I always say, one night stand, you gotta have protection. But in a relationship, maybe not, all right? So for a short-term trade, you gotta have protection by placing a stop loss. You gotta have a predetermined stop loss, so the moment you get in doesn't go your way, you gotta get out, don't hang around for the next day. So while I have a portfolio for investments that builds my wealth for the long run, I also have a portfolio for short-term trading to generate fast cash. So for my short-term trading, it's purely based on technical analysis, entering based on technical price patterns. So one pattern you notice in the markets is when a stock is on a clear uptrend, it goes through a wave pattern like that. It goes up, retraces, bounces up, retraces, bounces up. So in this approach, we look to enter during one of the temporary bounces to buy here and to get out at the end of this wave before the next retracement. So this is known as swing trading, right? Get in, get out quickly, move on to the next trade. So how do I tell that it's likely to bounce and continue the trend? Well, there are few rules that give a clear edge in the markets, right? So step one, for example, I gotta see the moving averages on an uptrend sequence. So over here you can see it's going up, it's bouncing. Do I enter here? Well, first I can see the moving averages are in sequence, right? From the 18, 50, 100, 150, 200, they are all in sequence from the smallest to the largest moving average. So once the moving averages are in sequence, it tells you the trend is very strong. Number two, I use MACD to measure momentum. So at that point, I want to see that MACD shows bullish momentum. That means the price has got upward momentum. Next, when I'm entering, I want to ensure that the stochastics is oversold, which means that the price is temporarily oversold, waiting to snap back up. So all the stars must be aligned. Okay, I also use Fibonacci, where I measure the length of the impulsive wave, A to B to the end of the corrective wave. It's a 50% retracement. So this gives me a high probability that at this point the price is going to bounce up to form the next wave, the next impulsive wave. So I enter right when it bounces up, when I have got a confirmation candle, which again, I teach all this in my professional stock trading course. So I enter in this case at 44.70, all right? And I've got a predefined stop loss exit where I place right below the swing low. So my stop loss is already there at $43 to protect me. So from 44.70 to 43, my risk per share is $1.70. I call that my 1R or my risk that I'm taking. Now, if I'm risking $1, I want to make $2. In this case, if I'm risking 170, I want to make 2 times that. I want to make 340. So 340 plus 44.70, I have my profit target, which is preset as well. So I've got a predefined stop loss, predefined profit target. So the moment I enter, I either win 2R or I lose minus 1R. All right. And I use a certain calculator to calculate the number of shares to buy. So if it's a losing trade, I lose 1% of my capital. If it's a winning trade, I win 2% of my capital. So you can see that when you enter a stock based on a short-term trade, when you sell based on taking a loss or selling based on profits, is objectively predefined. The most important thing in trades is to always ensure that never let a trade turn into an investment. Because a stock that may be a good trade may not be a good investment. It's like some people are good for dating, but they're horrible as wives or husbands, right? So never let it turn into an investment. And that's the mistake that people do, right? So for example, some people, they say, okay, I'm going to take a short-term trade. I want to make money fast, right? So they buy at 44.70, but they don't place a stop loss. They say, well, I will sell when it gets there, you know. So what happens? They get in, and when it drops to $43, guess what? Because of emotions, they won't sell. They say, you know, I thought it's going to go up. I want to be right. I don't want to lose money, right? Give it a bit more time. So they let it drop, right? Let it drop, let it drop, let it drop. Or they may even shift their stop loss down to give themselves a bit more room. And guess what? Instead of losing 1R, losing 1%, right? If it crashes all the way down, they lose a big amount of money. And this could happen. Why? Because for short-term trades, these stocks may not be good investments. They may not be good businesses. They're just having that technical pattern that once the trend reverses, it could collapse all the way down and never come back. So here's an example of a stock that was a really good trade setup, but it's not a good investment candidate, right? So you can see it was a good trade here because it bounced off the moving average. And at this point, it looked like a great trade entry. It met all the criteria, right? The MACD was bullish, Stochastics was oversold, moving averages were in sequence, it was an uptrend. And if you had bought at $37, but you did not place a stop loss at 35, because you thought real men don't put stop losses, right? I will do it myself, right? And you buy at 37 and it goes down, and if you did not sell, you say, okay, I'm going to hold, it's going to come back, right? I'm Warren Buffett, I'm a long-term investor, and you let the trade become an investment. Oh my God, from 37 bucks, it goes down to $22. So instead of losing 1 hour, which was $2, you are now down 7.5 hour. So in trading, one bad trade, if you don't control the risk and get out fast, it could wipe out many wins. So that's why there are some traders who say, you know what, I win 9 out of 10, but they still lose money. Because each time they win a little bit, but one time they lose, everything gets wiped out. So in my courses, I tell people that when you enter a stock based on a trade, you gotta follow your trading plan. So your trading plan means when you enter, you gotta have a fixed profit target and a fixed stop loss. So you know that you can't always win all the time. In fact, in short-term trading, you tend to win about 50 to 60% of the time. That's the reality. Now, this is different from investing. When I buy a good company, my chance of winning is more than 90%. In fact, I can tell you it's close to 100% because it's a good business. But in trading, forget about 90 to 100%. If you can get 50 to 60% win, that's really great. And you should always accept the fact that you will lose 40 to 50% of the time. But if you control your losses, so when you lose, you only lose 1%, and when you win 2%, you make consistent profits by trading. For example, if you do 20 trades a month, right? You get in, get out, win, lose, move on, right? And if you get a 60% win rate on each trade, it means you're getting 12 wins and 8 losses. And each time you lose, again, you control your loss to 1%. You cut loss fast. When you win, you take profit. Don't be greedy. Get out at 2%. All right, a 2-hour win. So each win is 2%, that's 24%. Each loss is 1%, it's minus 8%. You're still netting 16% a month. Okay. Now, even if your win rate drops to 50%, you're right half the time. Which means in 20 trades, you win 10, you lose 10. Each time you lose, you cut loss. At the predefined stop loss, you lose 1% per loss. When you win, you take profit at 2R, that's 2% times 10 trades, 20%. You're still netting 10% a month. So now I hope you really understand the difference between investing and trading. They are two totally different games with different rules on when to get out. Now, whether you are a successful investor or a successful trader, understand this. To make money in the long run, you must learn to sell. Hi, so if you like the video, you can subscribe for more videos by clicking the subscribe button. If you want to find out more about our live training courses in Asia, go to wealthacademyglobal.com. For online professional stock and forex trading courses, you can go to piranhaprofits.com. So this is Adam Khoo, and I'll see you soon.